So has anyone seen this? Hands up. Oh, there's a few. OK, so this is edition 1, certificate in ESG investing. I would say it's worth just getting the book, even if you don't want to go and do the exam. Exam is good, but there's a lot of really useful information here, even if, as a co-author, I must say so myself, about how to start cross-asset classes and a kind of real good 101 is like the whole start for ESG investing. So I also thought I'd check, I mean, how many people in the room are kind of mostly interested in fixed income? You can answer more than once. It's about a third in fixed income. This is like Slido, but much cheaper, right? And who's really into equities? Okay, maybe 60% equities. Private markets. Oh, it's a good chunk of private markets. Property, infrastructure, alternatives. There's a good handful there. Okay, and then we'll split it the other way. How many of you are more kind of analysts or analyst portfolio managers? That's a good half. How many are more sort of on business development, sales, product, that type of thing? Okay, good to that. And who is the kind of intermediaries, asset owners, that type? A few on the asset owner side. Okay, right. So I'll try and weight it to some of those interests. So, who doesn't have an answer to this question? What is ESG? Good. You're all at the right conference. If any of you had your hands up, I think you'd have to go to another conference around the corner. So it does actually mean different things to different people. So in our family, actually, ESG means eggs so good. Now, part of that is that we've got different things to different people, but there are kind of similar principles and things which apply as a philosophy. But a little bit like today, if you say, oh, I'm a value investor, the next thing you kind of ask is, well, what type of value investor? What's your process? What do you use or not? And I think that's where we're getting to the stage of ESG. It's a kind of catch-all phrase, but it covers a lot of different range of techniques and interests across asset classes, and you need to dig a level deeper in order to really figure out what it's all about. And so why do we care? So we've talked a little bit about regulators there. We've also talked about demand from the client side and things like that. From the investor side, we're kind of really interested in the fact that we think it lowers investment risk, it increases investment returns, and even if you don't think about that, it gives you a whole set of other tools in order to do your analysis of companies or portfolios better. And it should also help you improve the quality and engagement in your stewardship work. So another little pop quiz here. Who thinks that ESG can help reduce risk in your portfolio? Hands up. All right, we're all converted. The room thinks it's. How many think it's also an alpha source, though, can help you and get better returns? Almost, so that kind of 50-50. And how many use kind of ESG type stuff in stewardship or engagement work or due diligence with companies? Okay, so that's about half as well, maybe a little bit more to go on that. So why is this kind of happening? Just one slide on the kind of why, because it also links into the how later on. And Fiona referenced this earlier. It's the kind of interconnectedness of everybody and a big shift in drive and transparency. So why are we having climate strikes, divestment movements, 350? Well, this is a change in what people think. Who are the people, though? They're people like us. They also work for companies. We're voters. We're investors. We're trying to influence government and policy. And now with transparency into our pension funds, you're putting a lot of pressure onto trustees or the pension fund managers themselves to try and push in the direction of where you want to go. So this kind of siloing of, you're left, you're right, you're up or you're down, actually there's a much more interconnectedness on the system, which is one of the kind of megatrends pushing us to do all of that. And because how do companies get value? Well, they get value from their customers, their suppliers, they're part of their regulators, and then their own employees. And that's us as well. So the kind of whole movement on this is perhaps much more interconnected than we might allow for. And the other point, so this is into the ESG data conversation and all of this, is that actually a lot of what we would call ESG extra financial intangible data is simply not recorded in GDP. No economists think that the wealth of a nation is embodied in GDP totally. There's no natural capital. R&D only came in there recently. Human capital, social capital, intellectual capital, all of those capitals that accountants might call, not on GDP level. But there's also a lot of evidence that they're not really in company report and accounts. So Lev and Gu have done some work on this. Stone Westlake and Jonathan Haskell have done some work on this as well. And report and accounts, as measured just by what they give you in financial terms, really not explaining the vast majority of companies' valuation today. So kind of even if you don't believe in some of these other things, you're kind of going, well, this intangible value, we should be spending more time looking at it. We've also got the flip side of the problem, which is that not everything that can be counted counts, and not everything that counts can be counted. So in report and accounts today, we have a huge amount of pages, hundreds of pages now in report and accounts, most of which most investors do not use very much at all. And on the flip side, we've got a lot of intangible ESG data, which we're wanting more of, and we're getting all that, and a lot of it isn't really reported. So you kind of got this two-way tension, which is what a lot of ESG analysis is about. On the question of ESG, will it ever prove that it can be an alpha source? Well, actually, quite frankly, I don't think you'll ever get to a state where you can academically prove it. We're still fighting over the value factor, right? Some people think it's there, some people think it's alpha, some people think it's beta, some people don't think there's a signal anymore. I don't think we're ever going to come to a definitive case. But where you've looked at it in certain narrow aspects and you combine some of those studies together, there is a definite call that some of these ESG extra financial factors seem to have produced better returns for company in terms of stock and also in terms of reporting metrics. Alex Edmonds have done one on employee engagement. Caroline Flammer have done a couple of studies on long-termism and also incentives. The Khan study has looked at really the materiality. And Elroy Dimpson and his collaborators who are speaking later have also looked at this in terms of stewardship and engagement. So into the how. This is, again, is a whole spread, and you can look at this in the CFA and PRI case studies. There's a whole host of techniques. Not everyone is going to use all of them. They vary across asset class and strategy. But if you've not picked up one of these techniques and it could be useful for you, I think you should have a look at them. So how do those techniques kind of go with the theory of how firms create value, at least over the long term? Well, the idea is you're taking these various, let's use the accounting speak, various capitals. So financial capital is one, but you're taking intellectual capital, social capital, natural capital, human capital. You're running through them through a business model, governance, management, ideas, and out the other side, you're getting profits, hopefully, maybe not today, other financial capital, but you're also getting goods and services, human capital, intellectual capital, other kind of properties coming out. So you're combining all of these capitals, putting them through, and you're getting kind of more of these capitals on there. But you can see in those components, the kind of financial aspect is actually relatively small in today's speak. A lot of them would fall under these kind of ESG headings. So how do you translate that theory into where we're thinking? Well, this is kind of an overview which I'll try and refer to. I'll look at this kind of a little bit from the credit and the equity side and maybe try and pull in some of those other things, teeing this up for other people to go deeper dive in their sessions. But you're kind of hoping in the long term, your shares or your portfolio is going to go up and down, hopefully up. And at the moment, we're spending a lot of time on the financials which are leading to that, cash flows, debt, margins, and things like that in terms of fundamentals. But what are driving those cash flow figures, those sales, and things like that? Well, a lot of what's driving that are things like how good is your customer service? How good is your product? Are you looking after your natural capital? Are you looking after your people? What's your governance like? What's your culture like? And all of those are driven by really what we would put under extra financial or ESG. Now, the transition mechanism for all of this, everything in markets, is not necessarily linear and see-through. But you're going to, by doing ESG analysis, you're going to the kind of the causal factors in a much closer way. Plus, there's a lot of arguments that saying a lot of the financial analysis in terms of sales and cash flow is becoming a heavily commoditized area. That's why you're seeing the rise of passive, the rise of some areas of quant and that for what they can do. But as we know, they're kind of backward-looking, and they're meant to be really the outputs of what we've seen from a lot of this ESG factors as well. You can also do this in a credit-specific way because you're still looking at corporate performance. Okay, maybe you're concentrating a little bit more on the balance sheet and risk to balance sheets and things like that, but you're still interested in the factors which might risk things to the balance sheet. You can also think about this in terms of corporates, governments, sovereigns, and all of this, about what are those extra financial, those other capitals, which are really going to impinge in financial materiality over the long term. And that's even before you get to the systematic. Then, on the other side, when you get to the portfolio, obviously you've got a lot of stock-specific, what the quants would say as idiosyncratic. But then you have this kind of emerging arguments as like, well, how much of ESG or certain components of ESG can you put into some sort of factor? Is this a factor that we can control for alpha? Is it one we can do for risk? Is it something we should do for an overlay? Is it something that we can tilt on the portfolio? So you can come at it from a factor kind of attribute as well and get there as well in terms of where you're looking. So I'm going to go through a couple of these kind of areas as teeing it up for other sessions. In terms of fundamental active, it often starts with a philosophy and process, maybe even a purpose. I think this is quite interesting because this is a kind of reflection also on what you're seeing in corporate land, where a lot of corporates are now coming up about a purpose as a North Star for guiding your strategy. And we also know with purpose, and we've seen them a lot, you've kind of got greenwashing in terms of your purpose. It sounds really good. It's put on a really nice wall or plaque, but no one kind of really does it. So there's kind of culture and all of those kind of things as well. But it's a kind of interesting way of starting this, because a lot of this on your next books will start with your investment beliefs. And it's interesting we call it beliefs and philosophy because, as I was referring to earlier, a lot of this you'll not necessarily ever be able to prove in an academic sense. It's kind of what you believe should be a long-term good outcome for your investments and for your clients, however you figure it out. And actually, lots of different teams and lots of different asset classes have different purposes and investment beliefs, which was kind of what makes a market in this, all kind of hopefully pointing in the same direction. But even if you don't have a purpose, and actually I would challenge investment teams here in the room to kind of think, well, actually, is this something we should think about as our team? What is it that we're really trying to do with our investment process and philosophy, maybe at a higher order? It's not a prerequisite for using a lot of these ESG techniques. So a lot of the broad techniques are about, it typically starts as a research stage, a valuation stage, a portfolio construction stage. And actually, you have ESG integration techniques at all stages of this. You kind of often in terms of the research stage, you're gathering data. So this is kind of the data question. You're then using some sort of scorecards or materiality. You're generating ideas. You may screen. You may use checklists, scorecards. You may use materiality. Then you're putting it into some sort of your valuation, whether using ratios, balance sheets, DCFs, all of your standard kind of financial models. And then actually some of us are embedding it in portfolio construction stage, whether you're using it in a quantitative way or also in a qualitative scorecard kind of way. So trying to dive into that a little bit more. So this is an example map. This one is based on the SASB map, Sustainable Accounting Standards Boards. Although I would actually try and posit to everyone here in the room that without that much extra work, you can do your own map. So SASB is a kind of good starting point, and it might be a starting point if you're at a very low set of resources. But I think most analysts or portfolio managers, when they look at it, particularly when they're looking at individual subsectors or companies, always have an issue with one or two of the way that SASB does it. Well, if you have an issue with that, you should really be making your own map or thinking about your own materiality. And this is the other thing, is reasonable people can really disagree on where this materiality would lie. The importance of materiality is, I kind of guess, twofold. And you're seeing this within mainstream. So I don't know if you've ever had this with portfolio managers anyway. They're always saying, you know, what are the 3 things which are really driving this company? You know, what are the 5 things which are really driving this sector? And when they're asking that question, they're really trying to get to what are the material business or sector drivers. And this is really just another lens at trying to look at that materiality. I mean, every single standard energy analyst, mainstream, ESG, or however, is very cognizant of carbon tax. They should be more cognizant of regulation and policy. Essentially, that's embedded on where that materiality map is. What you might need is a larger scope of where you're thinking about what materiality is because of the nature of where intangibles in ESG has changed, and maybe because of some of the training that we've done within business school and even within CFA. For many, many years, it was just based on these kind of financial metrics without maybe thinking about the larger materiality at hand. Materiality also goes into it if you kind of want to use scorecards, whether you're doing positive or negative scorecards or using it as a kind of cutoff point. You really want your kind of material factors probably to be scored higher and your less material factors to be scored little or perhaps not at all. The other things about the materiality maps is that they can differ by company and or subsector, and actually reasonable people, again, as I said, they can disagree, and your actual scores may disagree about how you actually want to use them as well. And so this is an example of how you might do a map within healthcare, but again, you might have quite disagreements about how a SASB map is done, and actually you'll find there's a bunch of sell-side brokers who've also done their own kind of mapping in this area as well. It's also a really good way of maybe nudging some mainstream analysts who have perhaps been a little bit more skeptical into this by saying, well, what's material really to you? Can you really not think of kind of one or two business factors which you wouldn't classify on this as a starting point for them to really think about how this might be affecting their companies and the sector? So once you've done a lot of that in terms of your research, I mean, I won't talk about the data point so much as to say that people use various amounts of data sources because they typically don't agree. Then you're talking about embedding it in terms of what we're doing in standard financial analysis. So you can do it within a DCF. And actually, there are 2 or 3 myriad of ways of doing it within a DCF. So you can do it by explicitly adjusting some of your DCF assumptions. So, for instance, cost of capital, fade rate, terminal growth, and things like that. Now, in theory, that can be quite useful in terms of actually inputting what a cost or an opportunity might be. But the arguments might be, and I'll come to this in a little bit, that maybe the direct transmission rate is not as good as adjusting sales and margins directly, which is another way you can do it. So rather than adjusting things like cost of capital, you can adjust explicitly your P&L, your balance sheet, your things like that. You can also adjust valuation ratios in terms of relative adjustments. You can assess sustainability of business models. You can look at it qualitatively. That's also a good way of looking at the ESG opportunity side as well as the risk side. You can look at asset quality. You can look at balance sheet, quality metrics and things in terms like that. And you can either do deep dive works on other bits that you think are important, looking at your employees, looking at your incentive assessments, and looking about whether you should think of some premiums or not, depending on your own assessment of where the ESG is. So on the DCF, because that tends to be a very typical one used by mainstream analysis, so there's a very strong theoretical basis of intrinsic value. I guess the difficulties is it tends to be quite complex. It's very hard to say, oh, what's the thing which is really driving our DCF? Also, I mean, how many of us have done a DCF in the room? Hands up. Okay, so most of us have done it. You probably have. You can actually get almost any answer you want, right? So you can adjust what it is. So you kind of have to be careful as well. You're saying, okay, I'm going to give this a 50 basis discount or 100 basis here and there. We're going to be swinging that DCF value up and down quite a lot. So this is where you can have your discussion, whether you are the portfolio manager of your team, about saying, well, this is the impact of 50 basis points or 100 basis points there. And I think this is the kind of premium or discount we should be having, looking at the opportunities or risks that we're facing. It is those kind of discussions that I think you need. Otherwise, you're very, very open to manipulations. The other way you can do it is saying, okay, I'm going to keep the cost of capital the same. I want to do this across my sectors. I get sort of cost comparability, maybe the same with your fade rates and on your growth rates. And then what you're looking at is actually long-term, say, sales and margins. So if you're making the claim that this company is so much better in some of these ESG-type metrics, that it should be taking market share and should be better positioned in the industry, maybe it's better positioned in terms of carbon tax or regulation, then your year 10 numbers really should be growing faster than the industry and the competition. If that's not reflected in your DCF, then either your DCF is wrong or maybe your assessment of the company or sector is wrong. So that's another way of looking at it by saying, okay, let's not adjust our kind of fade rates or growth rates for that, but let's adjust it straight into the DCF scenario, and then you can have an argument with your team, right? This is worth 2 more points on sales. This is not worth on sales. There's no way this company or this subsector is better at that. I think you also got to be careful if you're going to double count that. So if you give it a discount on cost of capital and you're growing it faster than sales, is that a discount or something that you're going to want to do in a double way? And there's kind of no correct answer, right, on this. These are kind of tools and techniques trying to get a better sense of where intrinsic value is going to go in the future, driven by all these factors and things that we think. So explicit adjustments, I talked about that. So this is a problem where you get a materiality judgment error. And actually, this comes to one of the critiques because different people have different ideas about what materiality is. You can also do this if you're using old school valuation ratio metrics. I mean, most people are kind of like poo-poos, PEs, and EV/EBITDAs, still very well used, right, within mainstream portfolio managers. But they will often talk about, okay, I think company X or subsector X is worth a 20%, 30%, 50% premium or discount to the sector or however they do it. They kind of pull that out of the air, right? So you can kind of say that, though, with the kind of ESG thing. It's like, well, if you think this needs a 50% premium because of X, I think it needs a 20% discount because of an ESG risk, or I think it needs a 20% premium because of some ESG opportunity. Yes, somewhat we're pulling that from the air as well. So, but it's where the discussion is, because they might be pulling something else from the air to have that kind of discussion about where you might be. Is actually similar to what you might think of in some credit discussions as well, in terms of spread over treasury, about where you might be. You kind of often say, well, this is a premium, this is a discount, about where it might be. You also have the pitfalls of all of the ratio justifications. Generally, in academic literature, they're not liked very well. Okay, so turning a little bit into the credit lens. So you have a lot of these similarities of these kind of techniques, but they're embodied a little bit differently. So you still got the same flow, but you're looking more on the balance sheet side of things. And you're looking more about what might impact either your credit ratings or your default risks. Your assessment criteria might differ a little bit because you're a little bit perhaps more worried about the risk than the opportunity, although it can be on the same sides. And actually, you can extend this over to thinking about sovereigns and governments as well. This is another kind of example. I won't spend too long on it, but you can kind of think about fundamental credit measures, margins, leverage, and cash flows. And then you can have either qualitative or qualitative adjustments up and down on things like that, right? So again, you're kind of taking a company-specific or a subsector-specific way of doing that. And you might be scoring it in terms of strengths and challenges and doing a scoring that way. You might be embodying it straight into what you think your discounts and premiums might be, or where your ratings might be, or where you think the rating agencies might have got these kind of wrong. So you can adjust internal ratings, or you can say where external ratings are wrong, or where you think the spread should be differed. You might be doing your own DCFs. You might be doing your own balance sheet risk metrics. Again, you're thinking about those material ESG factors and embodying them into your process in terms of how you're getting a kind of valuation or an outcome. So I might turn now to quantitative. So here, I guess, the theory is, and this is it on a lot of factor investing, you know, there's a lot of arguments about why the value factor might work or not. Is it based on a real-world economic factor, or is it driven by a behavioral factor? Most people think it might be actually split behind a bit of a behavioral or an economic factor. So you're taking a lot of that, and you're looking at an ESG factor, and you're trying to see what can my quant model pick up. Maybe you're using your own proprietary data sources. Maybe you're using third party. Maybe you're kind of mixing them all together. And you're trying to find these kind of ESG signals, whether there may be an alpha or a kind of beta source, to try and make your portfolios better. The other things you might be doing as well is you might be trying to tilt to kind of real world factors, and I won't get into construction of indexes about carbon tilting or diversity tilting and all of these other things, and tilting towards those real world factors that you can see in your data, whilst not harming or at least keeping the same measures of other factors that you might be interested in: value, momentum, quality, are often the three which come up. So again, quantitative investors have a way of embodying this. There are very many different ways of doing it, whether you're tilting, whether you're looking at it systematically, whether you're combining data sources. They're kind of coming at it from the other angle, and whether maybe it's behavioral or real world, sometimes we're not really sure about. But they definitely have techniques and ways of embodying it in terms of what they're thinking in terms of their process. So they don't get out of this scot-free either. And I think we have Jason later on talking about this in one of the other sessions. So this is a kind of problem within, or maybe an opportunity within some of the data sets, is the fact that their correlation is relatively low. And so a lot of people think, oh, is ESG data going to save us? Well, there's kind of, to take the contrarian view, there's 2 or 3 reasons why actually in some aspects of at least ratings, we might not want them to agree. Like the last time I remember a lot of rating agencies agreed, I think it was kind of credit rating agencies, and that kind of led to a disaster, right? Because everyone thought, okay, this is gospel truth, this stuff is AAA, woohoo, let's go and invest, right? So actually herding effects, particularly when you have just 2, 3, or maybe 4 powerful rating agencies, might lead you actually systemically to the wrong place. The other thing, which is what I alluded to earlier, is there's still a lot of disagreement about what might be material or not. And in fact, interestingly, we argue about this in terms of ESG world. Now that I've dipped into like accounting world and standard setting, they still argue about this in terms of standing setting world as well. I don't know if you get some accountants in the room and ask them what really is cash, right? They can actually come up with a lot of different answers, which swings of billions of dollars. It differs either IFRS, US GAAP, Japanese GAAP in the old days, right? So we're not necessarily going to get absolute consensus of where these data points or where these ratings are, and you're going to rate them differently. That might be a problem in quantitative land, particularly if you're not maybe combining these data sets. But you still got some correlation, right? 0.3 is not necessarily, is not 0, and is not necessarily a nothing. You might have some R squared. You might be able to use some of that. And then on the flip side, for the deep fundamental active guys, this is an opportunity to really parse what's material or not. I still think we need more to go in standard setting, and that will help us, and we will get some level of more convergence. It's happening slowly. You've got lots of work going on with various people. But actually, if you look at it in terms of what we have in terms of accounting standards themselves, and they evolve every year, I think it's a false rabbit hole to think that we're ever going to get real consistency. And actually, from a systemic point of view, it might be something that you always want to have some elements of judgments about. In any case, this is a study mainly done by GPIF in 2017, looking at FTSE Russell and MSCI, pretty much limited correlation there. There was a Chatterjee study in 2014, which looked at the major ESG data providers at the time. It came out of a correlation of about 0.3. That's currently where a lot of the correlations are sitting. Although, as you may be aware, Sustainalytics are actually changing how their major risk rating is going into 2020. And we'll wait to see about how much that will align with MSCI. But again, when I talk to any of my quant friends, they will go, well, you know what? We only have a handful of years data, backward looking. Value factors had 50, 100 years. We're still arguing about that, right? It's all about forward looking. And if we are right, risk or alpha, forward looking, we're actually going to do really well by our stakeholders, actually by investors as well, because we're on the correct side of where the trend is going. Some of those quant machines, which are only ever going to be backwards looking, are hopefully going to get fooled by history about where everything is moving. So actually, there's kind of a lot of opportunity in that, as well as some challenges. This is another looking at it. This is from a Wall Street Journal article, so it's put in the public domain so we can talk about it. The fact that a lot of the rating agencies, when you look at it on a company-specific level, simply really don't disagree. I really like the Tesla example because it shows different views on environment, and also the fact that all 3 of them, and this is the tyranny of scoring by number, put governance for Tesla right in the middle, whereas you would ask most market participants, that's only the one thing that actually market participants agree upon. They probably don't agree upon anything else with Tesla, but they agree that actually its governance could way improve. So the problem is not thinking about it is, are these elements going to be objective truth? That ties into some of these kind of passive and active debates as well. So quant techniques, what are some of the current debates? Do ESG factors correlate with quality, value, momentum, other factors? Again, there is a debate here, but mostly the answer is no. Correlation seems very low, depending on your data set. Alternative data sets, combination of data sets. I'm actually going to leave Jason to answer that in a session later on. Again, there is no real consensus on that. There's an Axioma paper which suggests maybe some of it is common risk, some of it is idiosyncratic. Tilting or rules-based. And here you've got to think about, well, also, are we thinking about second order? So a lot of the tilting or rules-based ones, which are done, for instance, carbon scope 1 or 2, will have a lot of banks or financial services. Financial services are actually quite linked into carbon scope 3. Norwegian banks, Canadian banks are doing a lot of financing for scope 1 or 2 firms in terms of all services. You might not really be getting what you want just by a kind of naive scope 1 or 2 tilting. So there's kind of still a lot of debates in terms of all of that. But can you align with real-world impact? You've got some interesting diversity indices. Got some in Canada, GPF one, have got one in Japan. And obviously, there's this big debate about green revenue and taxonomy as well. OK, so pulling it all together, is there an alpha opportunity? Actually, the answer is yes. So this is share price dispersion, both looking at world and MSCI US. So the whole point here is that actually there has been alpha available. It's just portfolio managers have been really bad at harvesting it, right? So we need to do a better job. Arguably, I'm saying it's because we need to do a better job in both our stewardship and both our ESG analysis, given that so much of value is within that. So often you would say, oh, we can't get alpha in the US. Yes, post-ante, we've seen that we haven't got alpha in the US. It doesn't mean it wasn't there. It is there. We need to do a much better job of actually getting it. And actually, this is also you do it. If you combine what we're talking about, fundamental active as well as quant, actually, the quantitative guys can maybe explain a reasonable bunch of where the returns are. And so you can do that with systematic, smart beta, or quant. But there's a lot which is still what they would call idiosyncratic or stock-specific. That's the kind of risk that they tend to not like, right? Because their machines can't do it yet, although they're getting better. That's the actually risk that the fundamental guys should like, because that's the stuff we should be really good at, right? The stock-specific stuff, the culture, the innovation, how regulation should hit you, the environment, and all of that type of stuff. So if you classify it as that, stock-specific is another way of saying ESG risk that the computers aren't very good at yet. And actually, there should be a huge amount of alpha and value within that. Culture, human capital, innovation, how you're doing with policy, how you're doing with systematic risk, all of those type of things. It's actually up to managers, both active, systematic, smart beta, or however, to demonstrate an ability to get that sort of market opportunity and construct portfolios to capture the kind of alpha that you're looking for, whether it's quantitative alpha or fundamental alpha in terms of that. So I'll wrap it up here to just say that actually specific techniques, again, might vary. You've got different techniques across property. So go and, if you're interested in that, do listen to Nina on the property side. You might have building assessments. You might have deeper engagement. You might be looking at codes, policy, where you're doing in terms of boards. Again, within private markets, please listen to Michael Marshall, as well as a session on that. You might be looking there in terms of much more active ownership, how you're influencing the board. You might be actually having a role in setting policy. You might be doing it via due diligence via your partners or your third party. You might be doing it as an active owner as well as opposed to your asset owner there directly. You might be looking at performance standards. You might be doing this actually via your proxy voting. It does vary across asset classes. A lot of these principles still hold. You can even do it in event-driven, a lot of what we would call activism. You can take one step, there can be ESG activism or sustainability activism, turning around companies. I mean, Ørsted is where we are today. It actually used to be called Dong, which is Danish oil natural gas, or something like that, translated from the Danish. It's a company which transitioned. So, you know, you have all sorts of different ways of approaching that. We're wrapping up, coming to the end. I just wanted to make a shout out also to the work that Elroy Dimpson has been doing. He's got a session later on. There's been now a couple of studies on this, but essentially this shows that active engagement has added value to stock price, yes, but also to company fundamentals. And so this is particularly important where you identify material, ESG. This might be interlinking with policy. You might have issues on the whole free rider effect. This is passive versus active and things. But at least we know kind of systemically we should be able to add value by positive engagements here. And this work seems to be replicated. It also seems to make a lot of common sense and is really an extension of what we've seen in the activist field, which actually quite a lot of body of academic research, which has tended to show that's created value. OK, so some of the kind of challenges and critiques. I mentioned a lot of these. There's a lot of thought on this data, comparability, materiality, and judgment. There's a lot of thinking now, both on the corporate side and where we are. Can we measure culture? How important is it? role of stewardship hopes there? The answer is yes, but we're kind of looking at how we might manage it. The role of innovation, I think Fiona mentioned this earlier as well. We're not going to solve all the problems just by avoiding risk. We're actually going to have to innovate our way out of some of these problems. The role of purpose, is there purpose washing? Is it important? Can it really be used as a North Star? The role of incentives, are financial incentives the end all and be all? Can we put ESG into incentives or not? The role of diversity of thinking. Is it a business factor? Should it simply reflect societies of how we live today? Some of the critiques, are there bad actors? Are we using dubious criteria? Do you just rely on one ESG rating house and therefore you're not really doing it? Where do ethics and values go in? The difference between geographies, China and Japan, very different from US and Europe. How do you balance these stakeholders? We're saying, okay, we are looking at all of these stakeholders, but what do you do with that? That leads into debates of shareholder primacy, stakeholder capitalism. If we don't do a better job, are we coming down the line with blunt regulation, or is actually regulation going to be an unexpected weapon in this? Where do sustainable development goals, real-world impact? I touched upon active-passive factor approaches, stewardship, climate risk, systemic risk, how does that fit in, particularly if you're just looking through the lens of a company? Issues with greenwashing, to what extent that is that? How does that go down the chain institutionally and retail? Where is the idiosyncratic alpha? Am I really right in terms of is it ESG? What about fees? Fee compression actually across the whole industry, but if you're going to pay for stewardship within passive funds or actually within active, or that, are we going to have to actually argue for keeping fees where they are or even going up? And then in which case, can we justify what we're spending the money on our clients' behalf? Are we really doing what they really want to do with the money? A lot of these are currently in debate, have no firm answers. Oh, and the last one on the long-term value creation, pulling from the good old Warren Buffett. Someone's just sitting in the shade today because someone planted a tree a long time ago. This is the generational long-termism point about where a lot of that, and arguably say, that is one of the purposes of asset management. We want to be allocating capital to good ideas and good things, and away from bad ideas, bad things, and that is kind of what gives us a net benefit, hopefully, to planet, people, and the world.
That was a great presentation. We've got 7 minutes, but we've got at least 4 different groups of questions that I want to ask. So it's going to be sort of 2-minute answers to each of those. Right. So the first group is around your framework, and sort of 2 specific questions. How do you think about integrating timelines into the analysis? There may be ESG risk or opportunity there, but it might not materialize for 3, 5, or 10 years. And also pointed out that the framework appears to work for a comparative analysis in S&G, but doesn't seem to handle the externalities associated with E.
Okay, I'll try to remember those. Start one with the timelines. This is quite an interesting one because actually we often say ESG takes a long time to flow through because a lot of this, the market doesn't really understand, and so the information leaks out over a slower basis. That's true some of the time. But some of the time, actually, because markets are generally, as we expect, a forward-looking pricing mechanism, they actually price it in very quickly. So an ideal example kind of an ESG risk is patents, right? Patents actually have a 10-year, 20-year life. You lose that patent, your share price gets dinged immediately, right? That is a long-term effect with actually a short-term price signal. That might change with a lot of these things. Think about carbon regulation. Say tomorrow a carbon price did come in and the world actually agreed to it of $100. The market will shift very differently. So a lot of these are long-term effects, but if your analysis is a long-term period, but they discount back to today. You've also got shorter-term effects, even within kind of money markets, right? You've got regulatory risk, you've got reputational risk, you've got counterparty risk, fraud risk, all of those type of things, which are kind of, maybe you think of them as insurance risk, but they can actually embody in shorter-term timelines. And this is where, going up the chain to asset owners, you might be trying to match your liabilities, which are typically longer term, but sometimes you might have shorter duration liabilities. You might be doing this in credit. Actually, there's ways of embodying ideas of ESG and all of that in shorter term timelines.
Right. Externalities.
Externalities. Well, this is where a carbon price might help. It's coming through. Actually,
but the point was, is the framework resilient to externalities? Because it seemed to be that a lot of the content was sort of as is, sort of static content, rather than being.
Yeah, well, I think if you do your forward-looking forecast well, I think they should be resilient also to the E. It's slightly harder because you don't have such strong market signals, but some of them are there. Some of them are the sustainability within your business model. Some of it will come through regulation and policy. Yes, some of the metrics around natural capital accounting are only in their sort of infancy, but we can see broadly where they're hitting across subsectors and sectors, and particularly with that analysis. So I think if you dive deep, you should be able to put some of that pricing. You have to get second or third order impacts, though, about how will that be reflected in the world and regulation and all of those type of things, which does make it a degree harder, but not impossible.
Okay. Another question, or a different question, but how can you evidence the outcome of your ESG approach to clients? And explain.
Well, so clients. So I tend to answer this a little bit like, I don't know if there's any physicists in the room, but is light a wave or a particle, right? The answer is kind of yes. The whole point about being really integrated, right, is that you can't really pull it out. It's the same with corporates. So we look at these things. It's the same with the kind of interconnectedness. You kind of pull it out to do your kind of assessment and valuation and things like that, because that's how you have to slice and dice the world. But the whole point about being integrated is a deep embedded part of how you think about that. And sometimes the answer might be 1%, and sometimes it might be 100%, right? You might decide to invest or disinvest purely on one of those type of factors. So it's slightly a difficult or kind of the wrong question to ask. I understand why they're asking for it because of the way it's pointing and because we're having that. But it's because we can't even agree on the ESG data, you're never going to get a satisfactory answer. We don't have the data stream for long enough. It's going to be forward-looking. And so this is why I think it should, does it concur with an investment belief? Because you're not really going to be able to prove it. And my answer to that also is the value factor, right? You can get a whole bunch of academics, value growth, other portfolio managers in the room, and they're still arguing about whether the value factor works, whether you should do quant, whether you should do active, and all of that. So I would point to the studies. They're saying academically, where you can narrowly look at it, you are showing some value. But within that, in terms of your process, it's slightly too complicated to be definitively proved. Okay. That's kind of the honest answer.
Thank you. And there are a few questions around sort of ratings and the divergence between ratings, or the lack of correlation between them, and sort of asking, is that really a sort of significant obstacle to progress, or is it sort of an excuse for people to decide that you can't use them and therefore the data's no good? And I just wanted to mention the MIT paper that came out in August suggests that the average correlation is actually quite a lot higher than some of the older papers, because I think your data suggests it was at 0.3, their data suggests it's at sort of 0.6, and with some of the different services you're getting up to 0.7. So I think it is becoming...
It depends. And also where Sustainalytics will go.
Yeah.
You know what, there's pros and cons with this, right? So I would take an example of a financial factor, right? If I told you return on equity was 9%, I mean, what does that really tell you, right? Not a lot. Anything in isolation doesn't tell you an awful lot. It's the same with any one ESG rating or things like that. And in fact, you might find that, okay, if you go to a world where you're using a standardized ESG, you lose a lot of the forward-looking, you use a lot of the nuance, and they're still not very good on the opportunity. So it's both a risk and an opportunity, right? I definitely think that the industry is hidden behind this. I mean, no credit analyst thinks like a AAA rating is God either, right? So we're going to have to deal with it. It's going to be a way maybe in passive and quant, but I think we're hiding behind the data problem because it's never going to be solved.
Great, and we did not. We're just at 11, but I'm going to ask one more question because I know we've got a coffee break now. But it's a good question. But it would be great to get a sort of a 1-minute answer. In your engagement process, are you finding company management has become better ESG trained? And so is it can you get the same quality of information from management on ESG as you used to be able to?
Okay. So if I may, I'll take a minute and a little bit as the first to start to say is that
only a minute and a little bit.
Is not enough of us are asking these long-term questions in our group meetings. It might be different in a one-to-one, so I'm not going to, but certainly in our small group meetings, I'm not hearing these long-term questions enough. So in fact, I don't think I can answer that potentially because a lot of C-suite aren't being challenged. And I know we only have like 1 or 2 questions in a 5-person group meeting, but we really need to stop asking just about next quarter, where the margins are or what guidance is, right? If we can move away from that, then we might get a better answer. If you want my honest view, I think that there's a very, very roughly, and it differs between geography and sector and company. I think there's about 1/3 of companies which are really getting it and are there. There's probably a third of companies which are open and started and moving in that direction and can start asking that. And there's probably around about a third of companies which are somewhat lagging and maybe they're a little bit resistant. But to tell you the truth, that is probably a reflection of where our industry is going. If you looked at the CFA surveys, there's probably a split of a third. But we are actually all moving in that direction because of those interconnected drivers that I was talking about, your employees, your shareholders, your regulators, and your customers. And so they are getting better, but we need to be asking the right questions.
Great. Ben, thank you very much. Just before you go, please join me in thanking Ben again for a great presentation.